Here's another indicator showing just how overpriced the S&P 500 is. I gotta say there are four main valuations used when valuing a public company or stock. The most common one is what investors are paying for the earnings. That is known as a price to earnings ratio. Another one that is fairly well known is price to book value, which looks at how much you are paying for the assets minus the liabilities of a company. Not as well known as the price to cash flow, but we do believe here at Wilsey Asset Management that cash flow is very important for businesses, and like the other ratios, we don't want to overpay for it. The last one that has been around for many years is the price to sales ratio. This can be one of the best indicators because unlike price to earnings, there's no real way for a company to pad or manipulate the sales. They are what they are. As of now though, the S&P 500 is trading at 3.23 times sales, which is an all-time record high. When it comes to the price to earnings, the ratio is also high at 22.5 times projected earnings. And while that is not a record, it is well above the average of 16.8 over the last 25 years. Some people today are ignoring the valuation, saying that the companies are worth these higher values, but as I said, they are well above historical averages. The other problem is many of these popular names pushing the indexes higher are crowded trades, and it seems like everyone is in those stocks. The problem is, if almost everyone is in those stocks and there is a pullback for any reason, there are not many people that have extra capital to step in and buy more. We have also talked about margin hitting a record high of $1 trillion, and the problem here is if people have margin on their accounts, they could be hit with margin calls, perhaps taking away what little cash they had left, or they could be forced to sell out of the stock, which would then create more downward pressure. No one knows what will cause the bad news for a fall, but it will likely come out of left field. That could then lower future expectations, and that is when valuations will matter. The decline could be way larger than people realize. It's also important to understand what you are paying when you are buying stocks. Remember, they're not gambling chips. They are truly small pieces of large companies that do trade based on valuations. I'm Chase Wilsey with Wilsey Asset Management. If you like these videos, be sure to give it a like or comment, and feel free to check out our other YouTube videos and weekly newsletter for latest economic news, expert analysis, and market insights.